Welcome to Tenor Tech, where I solve the problems you didn't even know you had.
Begin by designing a clear chart of accounts so every transaction maps to one line item. Set up a chart of accounts with 10 to 20 accounts covering assets, liabilities, equity, revenue, and expenses. Number accounts consistently using 1,000s for assets, 2,000s for liabilities, 3,000s for equity, 4,000s for revenue, 5,000s for expenses. Assign default tax categories and tags for payroll, sales, and capital expenditures. Designate a default reporting period of 12 months and a fiscal year start date. Keep descriptions concise to avoid misclassification. Record each transaction with double-entry bookkeeping. Every debit must have a corresponding credit. For sales, enter revenue and accounts receivable. For payments, enter expense and cash or bank. Post 50 transactions per month or as they occur to keep ledgers current, and batch small receipts weekly. Use consistent dates and include source references like invoice numbers or Form 1099 where applicable. Verify amounts in dollars and cents. Include tax rates like 25% when relevant, and attach digital copies of receipts in your system for audit trails. Reconcile bank and credit card statements within 30 days and adjust entries for errors or timing differences. Match deposits and withdrawals to ledger lines, noting uncleared checks and outstanding deposits. Document adjustments with memos. Close books every 12 months and prepare summary entries for retained earnings, depreciation, and amortization. Review profit and loss alongside a balance sheet to verify account balances. Retain ledgers and supporting documents for 7 years for audits and tax compliance, and schedule a quarterly review to catch discrepancies early.
Thanks for watching. Subscribe to keep your life in tune.